Good afternoon. This is Karen Landry. I want to thank you all for joining us this afternoon. I'm managing partner of Spring Consulting Group, consulting and actuarial firm focused on funding employee benefits and captives, as well as a number of other things, including risk management, benefits consulting, and so forth. I've been involved in the field for more than 25 years, have 5 patents on funding employee benefit programs, and as a firm, we've won a variety of prestigious awards from Business Insurance, Risk and Insurance, Captive Review, and a number of other organizations that we're really proud of. Many organizations have looked at funding employee benefits because it saves money, and now the process has been streamlined. Obtaining DOL for ERISA-based benefits is moving back to fast track because Coca-Cola and Intel have their individual exemptions that you can cite. And the good news is that the new crew at the DOL have streamlined their questions and their process. There's also a significant amount of funding non-ERISA benefits like stop loss. That's an emerging and growing area of the marketplace. And there are turnkey benefit solutions that have come into play in the last couple of years that didn't exist prior to that. Employers continue to be interested in using employee benefits coverage to increase the amount that they have in terms of unrelated business, to help them with their property and casualty captives, to create overall financial efficiency and create additional savings, as well as help them have risk shifting and risk distribution on the tax side of the fence. And in a recent revenue ruling, 2014-15, it clarifies that other coverage like non-cancelable accident and health coverage is insurance, based on the spread of risk across individuals, and therefore companies can look to that revenue ruling in addition to 9293 to look at their unrelated business percentages and whether or not they want to add it to their captive or set up a separate captive. So just as we find on the property and casualty side of the fence, benefits has a lot in common with the P&C side of the fence in terms of when you use a captive, it can help you manage your cost. You can accelerate cash flow through premiums, claims, and reserving. It can help you minimize the frictional costs associated with the programs in the areas of commissions, taxes, risk charges, administration, and other areas. You can capture underwriting savings and the investment return associated with those reserves. It can help you improve your overall risk management and centralize your risk pool. Particularly, we see this in the case of international benefits where you might have many pooling partners. This is truly the only way to help you aggregate those pools. And it can provide reinsurance to help you manage the peaks that occur over the course of time with regards to the risk. Okay. It also supports employee retention. It's because it's a cost-effective way to fund benefit programs. You can customize it to meet employee and employer needs. A good example would be when 9/11 occurred, we had clients on Wall Street that had, terrorism and risks like that cut out of their coverage. They used their captive to supplement their existing life insurance coverage and account for that. You can have employees participate. Again, to the extent that occurs, you may need DOL approval. You can support the property and casualty coverages in the captive by enhancing the spread of risk, creating unrelated business in the captive for potential tax efficiency, and increased control. Just, I'm not going to touch on every point, but just in terms of designing the plan, minimizing insurer profit, improving management and reporting, and again, looking at multinational. If you use a captive, you get more real-time reporting as opposed to delayed reporting, which, many of our clients see as a big win using a captive with regards to those particular programs. So CICA recently did their fronting survey. It was rolled out at the March conference, and they asked about employee benefits. They've been asking about employee benefits for several years, and really this year, I know we're starting to see employee benefits continue to take off with the clientele that we have, but this survey really shows the impact of employee benefits in captives. Probably a couple of years ago, and with regards to pure captives, you saw a few people venturing in to fund employee benefits. This year, a number of people already have benefits in their captive, and many of the participants surveyed said that it's likely they're going to add benefits to their captives in the next 3 years, or possibly add it. And particularly around stop loss, there are a number of things driving the stop loss growth that we'll touch upon in a bit. But you can see that definitely benefits have increased over the course of time and really will be a topic on the front of everybody's mind for the next few years. With regards to pure captives aren't the only story out there, though. What's happened is, pure captives tend to be used by larger companies, but in the mid-market, we see captives taking off through group captives, seller captives, through association programs, in the life, disability, accident, and health, and stop loss again, marketplace, retiree medical, and also in foreign employee benefits, multinational pooling. So a lot of stuff, in the pipeline and more to come. When we talk about employee benefits, really there are a number of programs that that companies are looking at. Sort of the emerging areas are pension, defined benefit and defined contribution plans, to some people have already funded post-retirement medical, but more to come in that respect, to health, life, disability, sort of the old standbys. And then we do have other clients looking at things like voluntary benefit programs and how they handle those and how they might be able to help minimize the cost of those programs going forward. And we've tried to codify the ERISA-based benefits are in green on this chart. The non-ERISA-based benefits typically are in this purpley blue, so that you can generally keep track of them as we move along. So at a high level, what are companies looking at savings? And really, this is just indicative. It's based on your own experience and a review of, what you already have in your captive, whether there are any synergies that can be gained. But generally, we see quite a bit of savings on programs. And those savings come in different forms. They might come from a true underwriting savings, to acceleration of deduction, to elimination of unrelated business income tax, any one of a number of different areas. But suffice it to say, one of the big differences that I see is that most of the benefit plans that are out there are producing underwriting savings. That's obviously dependent on your losses and so forth. But many of the clients we work with, we do see underwriting savings as part of the program. So let's take a minute and focus on ERISA-based benefits. So there are ERISA and non-ERISA-based benefits. We're going to start with the ones that would be subject to the Department of Labor first. So, companies have been interested in funding employee benefits, but as many of you on the call, I can see some of the names and recognize that we've had discussions previously, or certainly would expect you to be a little bit aware of the fact that it may constitute a prohibited transaction. And the reason for that is it's a transaction between a party in interest, the captive, and the plan. And, ERISA goes on to describe the party in interest regulations as if you're a party in interest if 50% or more of the captive's premiums are related to the parent, and you directly or indirectly furnish services between the plan and a party in interest, the captive. It's prohibited unless you receive or can come under a Department of Labor exemption. So the Department of Labor provides 3 different routes for you to get and comply if you have a prohibited transaction. There are 3 different routes to be exempted. The first one is a statutory exemption. It's a 5% exemption for commercial insurers. Typically, this is why it was put in place, who insure their own benefits. Then you don't have to get a DOL approval in that instance. Many companies can't meet that test, meaning that only 5% of the premiums are related to these benefits that the insurer or captive is insuring. Many organizations can't meet that requirement. So they look at the other routes. The next one is a class exemption, and the class exemption by its nature applies to a broad range of transactions. And it says that if 50% of the captive's business is with truly unrelated parties to the employer, and you can write the business directly, you don't have to receive the DOL's approval. Well, a lot of companies can't meet that. They might have their own property and casualty coverages in the captive. They may not have unrelated business. Some do. An example would be an auto manufacturer that might have insurances related to their autos or whatnot for individuals, or other lines of coverage that they write for contractors that they work with or whatnot. But if you can't meet that test, you have to go for an individual exemption. And that the individual exemptions apply to your particular circumstances, requires DOL approval and review. And prior to 2012, that exemption application could qualify for the Department of Labor's what was known as X-Pro process, or if you heard people at conferences talk about it, it was known as the fast track application process. Okay. And what that allowed you to do was to apply for an expedited process as long as you could point to, on page 14, 2 substantially similar transactions in the last 5 years or 1 in the last 10. And what happened was there were a whole host of applications that went through the DOL exemption process, but the one that everyone pointed to, the last individual exemption that was substantially similar that most companies reference, was ADM. That transaction became more than 10 years old. At the same time, the Department of Labor had a change in regulators. Gary Lefkowitz, who had been at the Department of Labor, who was the captive person who did 7941 mentioned on the earlier page, and most of the captive filings that followed, he retired and another group took over. So that, combined with the sunsetting of the exemption, had that process sunset. Under X-Pro, the approval process took about 78 days, or about half the time, and the time obviously varies, that it would take for an individual exemption to be approved. So you can see how the X-Pro process would be very popular. In 2012, the DOL announced that it would be reviewing the criteria, and that going forward, individual applicants would need to follow the individual exemption process. So having worked on one of the applications that the DOL reviewed, what is it that they're looking at now compared to what they would have reviewed previously? So in addition to pointing to a substantially similar exemption, just as before you had to show that the plan would not pay more than adequate consideration for the insurance contracts, that no commissions would be involved, and that there would be a benefit enhancement. The benefit enhancement is an area that they're quite focused on. So in subsequent years, the formula used to calculate premiums would be similar to formulas used by other insurers. You'd have to contract with an insurer with a rating of A or A minus or better from an AM Best company, and that you have to use an independent fiduciary as part of the transaction. All of these items still apply, but the benefit enhancement and the analysis around the benefit enhancement has increased as part of the process. The DOL also takes the application and it typically puts together a list of questions to help the process move forward more smoothly. So someone's asked, what are some examples of benefit enhancements? And some examples are increasing the accelerated death benefit, increasing the amount of the multiple of salary. This is on life insurance, the multiple of salary that you offer to employees. Why is that an enhanced benefit? What do we have to do to prove that it is an enhancement? We had to look at what an individual with average health might get if they wanted to get individual coverage in the marketplace, what they might pay, versus under a group plan, which is generally cheaper, for a certain set of the population, and prove that it was indeed a benefit enhancement for the plan participants. So in March 2013, the DOL approved Coca-Cola's individual exemption, allowing them to reinsure their life and AD&D policies to their South Carolina captive. And on April 10th this year, the DOL approved Intel's individual exemption, allowing them to do the same with their life and AD&D policies in their Hawaiian captive. And that really sets the stage for others that want to go forward, certainly with life and AD&D, to look at using these two employers as sites for a fast-track application. In fact, the Department of Labor, who we've worked with to help them craft their criteria, has instructed employers that we're working with to review and to both of these filings and to use them as a basis for going forward. Again, while the criteria hasn't really changed, the focus has changed, and again, here's some examples of areas that would count as benefit enhancement. So it doesn't have to really cost a lot, so increasing the guaranteed issue limit is something that doesn't necessarily, especially if it's on something like supplemental life, it's an employee-paid plan, that's a benefit to employees because they can buy more coverage on a group basis without evidence of insurability, which if they had to go outside would not normally be something that they might find. Increasing the multiple of salary, as an example, another benefit, the accelerated death benefits really, what that would be is just accelerating for someone terminally ill when they could receive some portion of the face amount, some or all, of the face amount of the policy that covers them if they're terminally ill. And that can range from 50% of that face amount to 100%. And so those are examples of things you can look at adding that don't add on to your costs. Some of the other benefit criteria that the Department of Labor really likes are wellness benefits. And usually wellness benefits are something that many organizations these days with healthcare costs increasing, people are adding on in any case, and you can take a look at what's on your docket for additional benefit changes for the following year, and we often find we can look at those and make those work, for your program going forward, and it may even result in a reduced cost. So what's the anticipated timeline? Obviously, if it moves back to fast track, you're focused on getting things done in 78 days. Typically, we start out with a high-level review of our clients, and then we do in-depth actuarial and financial modeling, look at program design and benefit enhancements, work with the existing carrier or send it out for an RFP process, develop the submission to the Department of Labor, hire the independent fiduciary, and submit it to the Department of Labor for approval. And obviously, in the mix of things, the thing that's not on this chart is going to the Division of Insurance, which we would do as part of that in-depth actuarial modeling process to get a certificate of good standing, which you need to file for the, as part of the DOL application from the regulator in any given location. So another ERISA benefit that's received some press recently is the funding of retiree medical coverage. Employers typically don't need to fund their retiree medical coverage. There are certain areas in industries that have had a mandate to do so for a while, like energy companies, utilities. And early in the 1990s, several insurers received a private letter ruling on non-cancelable accident and health coverage, also known as trust of health insurance coverage. Many of these programs continue on today and have received plenty of benefits by funding their retiree medical either in a group like captive structure or other environments. In 2010, Coca-Cola received a DOL prohibited transaction exemption to use its captive to fund retiree medical with Aviva to purchase trust on health insurance from a commercial fronting insurer, reinsuring to their captive. But they didn't really take action on it because this non-cancelable accident and health coverage, all of the others that had gone before had private letter rulings. And because it was a unique type of policy, that wasn't, and all of the rulings that had gone beforehand were all private letter rulings, they really couldn't rely on it. In 2014, the IRS issued Revenue Ruling 2014-15, and it held that non-cancelable accident and health insurance can be treated like life insurance, and I'll go into why that would be the case at the outset. Typically, it is treated like a lifeline from a reserving standpoint, and because there's risk distribution amongst the large group of covered individuals, it could be treated as insurance for tax purposes. So it had risk distribution based on this private letter ruling. Now, why would somebody want to do this? And I can't speak for Coke, but I know our clients have looked at it to save unrelated business income tax, which is a tax that's owed on non-bargained, pre-funding of non-bargained employees pre-funding of retiree medical plans. By funding it, it offsets the liability. So some of our clients have funded their retiree medical because they want to clean up their financials and fund unfunded liabilities. It could also accelerate a tax deduction by funding. You can fund up to something called the qualified asset account limit. And it also, at the end of the day, by pre-funding, it's kind of like setting money aside in your savings account. You have the benefit of the investment return and so forth to provide you with a total lower cost of funding than if you just handled it on a pay-as-you-go basis. So the typical structure of programs like this are on the following page, where the employer funds the plan, and in the revenue ruling, it states that there's Aviva that's being used, and this is the way our clients have done this in the past. Employees can submit claims to the trust and be reimbursed for those claims, but the employer makes a contribution to the trust. The employer gets the deduction by making that contribution to the trust, the trust purchases an insurance policy from a fronting insurer. That fronting insurer then cedes up to 100% of that liability to the captive program itself. And then what happens is the captive reimburses the fronting insurer for claim payments. And claim payments is a little bit of a misnomer. I know that, you know, as people move towards more defined contribution types of plans, we view similar programs like this to handle the defined contribution arrangements as well. So what kind of savings are we talking about? Well, at $100 million with a 4% discount rate over 10 years, it's going to save $21 million. Certainly enough money to have many people stand up and take a look at how this might impact them over the course of time. We do have a question. How does including employee benefits in a property and casualty captive affect the status of the captive? Well, if you have 50% or more life business and looking at this non-cancelable accident and health coverage qualifying as life coverage, it would be treated as a life company. So that would be one effect. There may be many others, but it could change a captive from a life company, from a P&C company to a life company. One of the other things to think of, you know, that's a bit unique is this program was set up to fund retiree, you know, medical, you know, loans. So, you know, there are many other things that you could do to have it have little impact with your property and casualty coverages. Okay. So one of the other hot areas we're seeing take off in the market is the growth of medical stop loss. For large employers, you know, many plans have been self-funded for a long time. For mid-sized companies, many have remained fully insured, but the CICA survey indicates that medical stop loss, and this is our experience as well, is likely to show double-digit growth over the next 3 years. And certainly, we are seeing groups of employers, like educational institutions, banding together to fund their stop loss, other association groups funding stop loss programs, health insurance being such a large, in terms of the benefit spend, it's typically the largest benefit spend next to pensions that clients have. We're also seeing more turnkey solutions become available, offered by vendors to fund medical stop loss more easily than setting up your own captive program. And a medical stop loss can be an ERISA benefit. If we looked at the retiree medical funding, that trust-owned health insurance is like long-term stop loss, and that would be an ERISA benefit. The reason it would be an ERISA benefit is because it's funded through the trust, but typical run-of-the-mill day-to-day medical stop loss is not an ERISA plan. You certainly need to be careful about how it's structured so that you avoid it being an ERISA plan, but most companies that we work with want to try and stay away from it being an ERISA plan because they want to try and fund it without going through the Department of Labor process and, you know, want to keep it as simple as possible. So what's driving the interest in stop loss captives? You know, certainly it's the, you know, natural tendency, as with any benefits, to extend the existing property and casualty captives to include something like accident and health coverage, stop loss. It has the potential to improve the tax efficiency of the existing captive. Some of the other arrangements that you might look at as an employer are more cumbersome, like multiple employer welfare arrangements or other stop loss structures that are prohibited or might require more capitalization. There are you know, heterogeneous entities that can pool coverage. It can be funded in a cost-effective manner, and generally, stop loss is priced pretty conservatively. When you look at the overall market, you know, it's typically priced at a 65 or 70% loss ratio, so there's a lot of room for improvement in terms of funding and saving dollars. The other major impact is that as of 2014, we have healthcare reform having an impact on health plans, and one of the impacts is that they have a health insurance tax. That tax only applies to fully insured plans. For 2014, it was 2 to 2.5%. Going forward, it's 3 to 4% of premium increasing in the future, and it's a permanent tax that's built in to insured plans. But if you're self-funded or administrative services only, it is not applicable. So right off the bat, all things being equal, this is something that when translated into your healthcare costs, you're gonna save by changing the funding status. So as you move to self-funding, self-funded plans require stop-loss coverage, and that's one of the other areas driving the growth on health insurance programs. And perhaps adding one other item, for smaller to mid-sized companies, we see closely held businesses looking for ways to take control of their insurance costs and not only minimize their costs, but also accumulate dollars for other risks down the line by using captives. So there are a lot of different stop-loss structures. This is just one example. Many employers have both specific, meaning a deductible per person kind of coverage that they fund, as well as aggregate risk protection. And in captive speak, they take a working layer of risk and have a reinsurer or an excess carrier come in above that level. So in this example, the employer or the captive might retain some level of risk. In this example, the employer member, as part of a group captive, would retain something like $150,000 per member, up to 125% of expected claims. And then there would be excess over and above that to cover that, both on a specific basis at $350,000 per member, or on an aggregate basis, in excess of that 125%, and then the reinsurer would wrap around that. In this instance, we've seen captive stop-loss saving 5 to 15% of that cost, and for companies, saving that much money on healthcare spend is pretty difficult to do, without looking at something like a captive program, as well as taking a number of other measures in hand. Many of our clients, when looking at stop-loss, if they're part of a group, they also want to look at purchasing collectively things like their administrative services, network services, claims analytics services, wellness services, and all of that adds into the savings that might be able to be produced at the captive level. One of the other areas that companies are moving towards examining, and there's been a big increase in this area, is the use of captives and multinational pooling. Historically, it's been an area where many multinationals have been using captives for quite a long time, but I think more recently companies are looking to try and consolidate their multinational pooling programs. And the way a multinational pooling program typically works, and it varies by network, is that the home office has a subsidiary in multiple countries: France, the United Kingdom, Singapore, in this example, and the local subsidiary purchases services through a local network partner. That's a local network partner who's part of the global network partner, that they work with. This is without a captive being involved, and typically, when you look at, if you didn't have multinational pooling, it's like a typical insured arrangement where you have claims, commissions, taxes, expenses, and profit. The one big difference with when you add pooling is that you have a profit-sharing arrangement where there's a dividend or whatnot returned to the client or to the captive. And it covers a whole host of coverages from group life to pension to expat through a pooling program. When you, someone asked, do state stop-loss regulations, legislations apply to stop-loss captives? So typically, that's an it depends answer. Generally, captives are set up in a jurisdiction where the transactions occur in that jurisdiction, and so that might be a different jurisdiction than where their main office is. So those state regulations at the domicile level would apply. There are other state laws like quality and claims laws that may apply, but generally when you have a self-funded plan, ERISA preempts, you're still subject to federal regulations. So be happy to answer more questions if you want to take it offline. It's a bit of a complicated area, but in general, that's how it would work. When you add in multinational benefits in the captive really, the top half of this picture is the same as the picture that we had previously. The captive actually works with a global network partner, is seeded any one of a number of items, and may keep all the risk or be the final risk taker. But typically, the global network partner is getting seeded coverage from the local network partner. They consolidate it, and then they'll reinsure. They've deducted a ceding commission maybe at the local level, and then they may deduct another ceding commission at the network partner level and cede that risk to the captive as the final risk taker. There are lots of different ways to do this. There's a passive agreement where the captive is the contract holder for the pooling contract, and it receives that multinational dividend, sort of the simplest version, to where the captive retains some risk, certain level of risk for charges, a risk in a pool. For example, it might retain up to $500,000, and then the pool may take it out after that. It could directly write up to 100% of the loss below that level, and it would retain the underwriting profit to a treaty relationship where they're responsible for claims payments. They retain the risk charge, they get the premiums and the reserves, and and basically that way it's like a large deductible structure, improving their cash flow. Normally under a multinational pooling arrangement, cash flow and reporting are about 18 months after year end. You understand what's happened over the course of the year prior to that, so it's quite delayed, and the captive really accelerates it and improves the cash flow. Okay, so certainly on the captive benefit horizon, there are lots of new captive formations, groups, and so forth. There's expansion of existing captives. There are cell companies that have been developed to fund benefit needs. There are greater domicile choices. When I first started doing benefits in a captive, which was quite a number of years ago, many of the domiciles didn't even have language that allowed you to fund employee benefits. I think most domiciles incorporate employee benefits language. Some newer domiciles like Texas does not allow for that, but in general, there's definitely greater domicile choice, as has occurred just with the expansion of the captive industry. There's increased funding of unrelated or third-party risk, related to benefits. There's a greater focus on post-retirement costs in Europe and the U.S., where captives can provide an additional solution that's often a better solution than what exists in the commercial marketplace. And, you know, we see that clearly on the retiree medical side, but in the pensions area as well, where we just received one of our recent patents. We expect that to be moving forward quite significantly. We do have a question about multinational pooling. Have you seen companies have their multinational pooling arrangements cede to an international captive versus a U.S.-based captive? Yes, we have, and in fact, you know, there are carriers, pooling carriers that have cell captives that are set up in Guernsey and elsewhere that facilitate that. But many global companies have more than one captive. They might have something in the U.S. and something in Luxembourg, and so we do see that occurring pretty frequently. So, you know, just to summarize, benefit captives have come a long way. You know, 10 years ago, it wasn't common. As common, companies often perceived obstacles like reinsurance restrictions or the ERISA process or whatnot, territorial restrictions like the U.S. only, you know, and few employee benefits were reinsured by captives. There was limited HR benefits familiarity with captives. There was some insurer reluctance. You know, marginal economics were alleged, but you know, that's not what we've seen in the last 10 years. What we've seen is people are seeing the savings. One of our clients was recently interviewed by Business Insurance, and they've saved, you know, quite a bit of money over the course of the last 7 or 8 years since they set up a captive to fund their life and disability program. You know, more people, HR, finance, risk, are aware of benefits captive funding. They've heard from other people that it works. Certainly they see a lot more in the press about it. You have people like Employee Benefit News and other traditionally benefits publications publishing articles on a regular basis in that area as an example. Companies are also looking at enterprise risk financing, and that helps employers you know, have a focus on some areas associated with their people, like pensions, retiree medical, and health insurance that are truly enterprise risks that they might be concerned with, and therefore they're looking at captives to assist with that. You know, they're looking for captive solutions to provide some control. So clearly, as CICA has identified, and we would concur, you know, there's an increasing interest in benefits in a captive on all fronts: the ERISA front, the stop loss front, the multinational pooling front, and you know, we're excited about that, and think that we'll see a lot of innovation going forward in this area. Intel's prohibited transaction approval combined with COACS, we think will usher in a new wave of funding benefits, and you know, it will lead the way to allowing them to cite substantially similar cases.